Okay, thanks for having us here today. Thanks to Brianna for inviting us to this event. We hope to return the favor. Our next events, Brianna and Alex were able to join us in Tanzania a couple of weeks ago, so we're grateful for the collaboration. I want to ask a couple of questions first before I start. How many of you have heard of Mojaloop? About half the room, great. We'll work on that branding. And how many of you would say you are not technical? Okay, good. So I'm going to be speaking to you. Michael has the depth when it comes to the technical. So I'm going to give a little bit of background on Mojaloop and who we are, and then Michael's going to go a little more deeper into the platform and how it relates to Interledger. So as I said, I'm Paula Hunter, Executive Director of the Mojaloop Foundation. We're a nonprofit organization spun out of the Bill and Melinda Gates Foundation. Contrary to popular belief, we are not affiliated with them. We are a legal independent entity. We have our own board of directors, technical governing board, and other sources of funds. So we do operate independently, but continue to enjoy their support and encouragement. We spun out as an independent entity because we wanted to really expand our footprint with the community, the open source community, but also moving out into Africa and Asia for the Mojaloop platform. So it's been 2.5 years now that we've been operating as a Mojaloop Foundation. And our focus has been on central banks, particularly in developing economies. Primarily, our footprint has been heavily focused on Africa, although we're seeing a lot more interest in Asia now. And so we have some new projects blossoming there, and we have some team members in Asia as well. And really, what we wanted to be able to see happen is that central banks could adopt Mojaloop as the base infrastructure for interoperable instant payment systems, and then knit together their financial service providers in country to all operate on the same infrastructure. And we don't want to be exclusionary. I mean, we want the central banks, obviously, to adopt Mojaloop, but we also want fintechs and other financial service providers to use Mojaloop as well as a way to interoperate with other systems, but also as a way to expand their business. So we're not, anti-commercialism. We're happy to see people make a business out of deploying Mojaloop, supporting customers, implementing it to their customers. But our fundamental principles are that we are a public good. So all the work that we do in developing the platform is done freely. We contribute the code freely. It's an Apache software license. And we don't charge for our training, for our conferences, events, et cetera. So we really want to spread the use of Mojaloop as far and wide as possible. But you'll certainly see, a vibrant ecosystem of commercial players in the mix. And in my mind, having worked in open source for almost 20 years now, open source is a development model, it's not a business model. In order for open source to thrive, you need commercial actors in the mix, contributing to the code base, but also enhancing it, maintaining it, and providing services to their customers. So we feel that that's a really useful model to remind people of. We're not trying to undermine people's success in the fintech sector. We're happy to embrace fintechs and have them participate in the Mojaloop ecosystem. And that's the point is that, we do the non-sexy stuff. Let's face it, plumbing. We're about, the rails and the rules. And, sometimes I talk about it in the context of plumbing, sometimes in the context of the railway. In the United States, we're feeling the pain of a private sector rail system that doesn't interoperate well. And so if you're from Europe or other places where you have great rail systems, you do because the private sector doesn't control the rails. In the US, they do, and therefore, getting from New York to Boston on a train is expensive, it's long, it's slow. We want to provide rails that everyone can hop on and use interoperably and freely. So that's our focus. And then the differentiation to the consumer comes at the app and account level. So Mojaloop as a brand is probably not going to be recognized by the consumer. Because folks say, well, why don't you pump up the brand more to the folks through their mobile network operators and such. We really need to be transparent when it comes to the end consumer. We want the mobile network operators to know about us. We want the banks to know about us, the fintechs. But those folks own the relationship with the customer. They own the remit to differentiate their service offerings on top of Mojaloop rather than branding it Mojaloop. And as I mentioned, we obviously an open source platform, and I probably don't have to preach the wisdom of open source to all of you in the room, but for developing economies, they're still a little wary about open source. They don't understand it as well as developing markets. I mean, let's face it, Linux Foundation has been around for over 20 years. It's well understood in the commercial sector. But in the developing markets, we need to address some of the concerns and uncertainty and misconceptions about open source. And so, one of the things that's really important when we go into a developing market, which doesn't have a huge budget for infrastructure projects, is to explain to them that, first of all, there's a lower capital cost to engage. So, whether they want to test the waters, do a proof of concept, or go into full implementation, some of those upfront costs are mitigated by the fact that there's no licensing fees. That said, you need the skills, whether it be in-house or using a service provider, to help design and implement the solution. There's lower maintenance costs and lower costs to add additional functionality. Every 3 or 4 months, the Mojaloop community gathers. As I mentioned, we were in Zanzibar a couple weeks ago, had over 100 people there, and the whole week was focused on what are we doing with the code base, what does our roadmap look like, what are the customers telling us are important. We had representatives from Bank of Tanzania, from Guinea, from Myanmar, Philippines, on and on and on. All those actors came in and provided us input on what they think is important for the next iteration of the code base. So the customers aren't writing a check to XYZ company to add new features to the software. They're coming to the community and in some cases making recommendations, in other cases saying, and we'll help you write the code. So that's a really useful model for entities that don't have a lot of staff on hand. And then no vendor lock-in. They might decide to hire a service provider to implement Mojaloop in-house. They start operating it. They decide they don't like that vendor. They can shift to another vendor. The license is free. They're not locked in to working with one vendor. It sounds very fundamental, and if you've been working in open source, I forget how important these basic premises are for open source. But if you're in a developing market that's not familiar and wary about open source, these are the fundamental principles we have to really drive home. And I mentioned our community. Right now, we have hundreds of people touching our community on a daily basis. You're welcome to check things out on GitHub and Slack. But even to look at the breadth of contributors, these are people that actually sign contribution license agreements, are contributing code back to the Mojaloop Foundation. You can see it's a very diverse group of people across all 6 of the 7 continents. So very robust group, continuing to grow, and we'll be meeting again in Rwanda in March. Just contact me if you want more details. So at the end of the day, what we're trying to do is build an ecosystem that can benefit from this investment we've made in this open source code base, whether it be fintechs, central banks, governments, merchants, and then ultimately the users, because our mission is to address financial inclusion. But the way we have to chip away at that is by talking to all these different parties in the ecosystem so that we can get those transaction costs down and interoperability up. So that's our remit. Nurunjay really did set the stage for us. A lot of the points that he made are our reason for being. So with that, I'll thank him for his comments and turn you over to Michael for the depth.
Well, let's hope so. Thank you very much, Paula. Now, when I sent my slides to Paula, she gave me what my mother would have called an old-fashioned look and said, "You got a lot of slides there." And I got to admit, it's true. So without further ado, let's get going. I want to start by looking at the state of affairs today, where there's bad news and good news. So look at today as reported by a recent report from African Ender about the state of instant payment systems in Africa. Then it says, well, the good news is there are nearly 30 instant payment systems today in Africa. The bad news is almost all of them are financial institutions which rely on high transaction values. Read banks and real-time gross settlement systems. So these are the high-level systems that banks use in countries to do large-scale settlements between them. They don't include other kinds of non-banks, other kinds of institutions, and they're definitely not geared to low-value payments. The good news, on the other hand, is that when people are presented with solutions that meet them where they are, and that means both physically and mentally, people move to formal financial services regardless of their income level. Now, this is an important point because if I had been given this talk maybe 5 years ago, there would be a lot of research that says getting people included financially is really hard work. It takes a long time, and typically they go back into older forms of behavior quite soon after the experiment. It appears now that the problem is that we were trying to include people in the wrong way. We weren't going to go to them where they are and to try and engage with them in the way that they want to be engaged with. And when we do that, then it turns out things are much better. So our objective then is a simple one. It's profitably, reliably, and ubiquitously, if that's a word, to execute payments of an average value of less than $1. So they've got to be operable. People have got to make money out of them. There's no way around that. But they've got to be operable at a very low per transfer value. So I want to look at two particular stories this morning. First of all, I want to look at driving down cost, and second of all, at driving up openness. So those are the two key focuses for the work that we do in the Mojaloop Foundation. So when I talk about driving down cost, I've got the following topics to talk about. First of all, what I'm going to call table stakes, which is a term I took over from a product manager whom we used to have. And second, eliminating indeterminacy. And third, convincing people that they will always get paid. So table stakes, what does that mean? That means the things that you've got to be able to do in order to join the game, but which no one gives you any credit for having done. So for instance, we say, we don't use specialized networks. We don't want to use VPNs because a lot of the institutions that we want to connect don't understand that kind of thing and can't get on with it. We want to use the open internet, the internet that everybody else uses, and we want to be able to secure the messages that we're passing across that open internet against any interference. Second, we want to avoid relying on long-running transactions. In a lot of the areas where we want to operate, internet service is unreliable, often things go down for short periods, and therefore the less time we keep a connection open, the more likely things are to succeed. Now, an asynchronous pattern, which is what I would call that, is much more complicated to implement, but it's much more reliable. And finally, we don't want to insist on sophistication in our participants. We use adapters, which conceal the complications which are inherent in things like making sure that messages are secure in transit and on the asynchronous patterns. We conceal those from the participants by providing adapters which they can use simply on their side, but which encapsulate the complexities of the actual connection to a Mojaloop network. So those, as far as we're concerned, are the table stakes. the things that we just have to do, because if we didn't do them, nobody would pay attention to us at all. But as I say, we don't get, or indeed expect, any credit for having done them. So let me talk then in a bit more detail about eliminating indeterminacy, which is one of the fundamental importances for us. Now, Warren Buffett, whom I guess most of you will have heard of, once said, risk comes from not knowing what you're doing. Now, you can interpret that to say risk comes from being around people who don't know what they're doing, which I guess all of us have had some experience of. But I think that's not quite what Warren Buffett means. At least it's not what I want him to mean. What he means is that there's always a risk when you're doing things but you don't have an absolutely clear idea of what's going to happen as a consequence of what you do. So financial institutions will always hedge a risk. They'll always take out a form of insurance to make sure they're not left financially exposed by taking a risk, by doing something where they're not quite sure how it's going to turn out. But hedging, unfortunately, advantages big institutions at the expense of small ones. So it introduces an asymmetry into the market that makes it much easier for large institutions to succeed and much more difficult for small ones. And in the end, that's all money wasted. I mean, the cost of insuring against failure is a waste of money. It doesn't get you anything. Mojaloop's answer is, first of all, we want to remove indeterminacy from the payment so that people always know what's going on and what they're doing. Now, how do we do that? Bit of complexity here. So first, we always ask the parties to agree on the terms of the transfer before anyone is asked to execute the payment. So this is something which I think is, it's not unique, but it's something that when we talk to other people who implement instant payment systems, they generally don't do this, but we think it's a point of fundamental importance. We think that if we get parties to do the heavy lifting, first of all, to agree that a particular beneficiary can be paid, to state up front what the fees will be as a consequence, if currency conversion is involved, what rate will be used, all of those kinds of things. And then, once we've done that, the terms are cryptographically locked so that all parties can verify that the execution is an execution of the terms that were previously agreed, and that nobody came in and said, oh, actually, I think I'm going to add an extra fee there, I'm going to change the rate, all of those kinds of things. So the terms are cryptographically locked so that everybody can verify and that nobody needs to commit funds except under the terms of that agreement, so that everybody knows in advance what they're going to have to pay, what they're going to get. So second, we use non-repudiation signatures to make sure that everybody knows that a message, when they get a message, it came from the person who is on the sender label, it really did come from them, and also that it didn't get changed by anybody else. There were no man in the middle of attacks, nothing like that, that the message that is received is exactly the same as the message that was sent. Now, again, for technical people, this will not be a new idea, but it's a fundamentally important one because it gives people, participants, confidence and trust that when they get a message, it really is coming from somebody else in the network and that it really is what they intended to send. Third, when the debtor party, the sending bank or institution, requests execution of the transfer, it resigns all its rights to influence the outcome. So once the debtor institution, the sender, says, please execute this transfer, it has to abide by whatever happens. It can't intervene after that and say, oh, actually, I'm not really sure I wanted to do that. It's got to go ahead and accept what happens as a consequence of requesting the execution. Now, the creditor party, on the other hand, is the party that's taking the risk. We're asking the creditor party to say, I will transfer those funds to my customer before I actually get them from the sending institution. We allow the creditor party, the receiving party, to postpone completion until it gets notification from the central hub that the transaction has actually completed successfully. And the creditor party is allowed to reject the transfer. It has to be like that because one consequence of agreeing the terms in advance is that it's possible that something may happen before the payment is executed. For instance, an account may be suspended so that it's no longer possible to make payment to that account. So what we have to allow the creditor party to say, no, I thought I was going to accept this, but actually I'm not going to. And if it says that, there is no comeback. It's allowed to say that, and the transfer fails, and in the end, no funds get moved. And finally, there's just an edge case where a transfer times out. And that's because we use timeouts to ensure that transfers can't remain in an indeterminate state. Now, as I said before, we want to be able to operate in situations where it's possible that people may drop out of communication at various points. They may not be able to get onto the internet. Institutions may not be able to communicate with each other. So one of the things we do when a transfer is requested is the timeout is set. And the switch checks that timeout, and if it's exceeded, the switch cancels the transfer and notifies all the parties to the transfer that it's been cancelled and they will have to send it again. But that means that we don't have transfers that are sitting about, sometimes for long periods, without anybody knowing whether actually the funds should be transferred or not. Okay, so that is how we plan to remove indeterminacy. Let me move on to the question of how we make sure that people are confident that they will get paid. And by people here, I mean the receiving institutions. Now, we want to be able to include lots of institutions, very small ones, and therefore we need to be able to provide them with guarantees that if they're getting a transfer from a big bank, the big bank will pay them. So we require participant institutions to provide collateral pardon me, to cover transfers where they are the debtor. That is to say, to cover transfers where they are sending the funds or promising to send the funds. We also have a strict but fair policy. And the strict but fair policy says, because we insist on the agreement of terms, they don't have to commit those funds until they actually request execution. So they can be confident, or reasonably confident, that the transfer is likely to succeed before we ask them to provide that liquidity cover, the collateral, to cover the transfer. And also, we only reserve the transfer funds, we don't finally debit them until the transfer completes. Now, this means that creditor institutions can always be confident that the debtor institution has the funds to reimburse the creditor institution for the transfer, and that those funds can't be spent until they've actually been transferred to the creditor institution as part of the process of settlement. So that means that even if you are a small village and savings and loan association and you're receiving remittances from people who are working in the city, coming through to you, you can be confident that you can pay out to your customers and that you will get the funds from the big city banks on a timetable that's agreed and on which you can be confident about. So that's my story about reducing cost. Next up, I want to talk about driving up openness. And here I've got 4 things that I want to talk about. First of all, support for lots of different financial institution types of financial institution. Second, support for many participant types. I'll explain in a bit more detail what I mean by that. Third, being able to pay beneficiaries, not accounts. And finally, opening schemes to external parties. Now, as Paula said, what Mojaloop does is it connects financial institutions. So it does that by implementing a hub-and-spoke architecture. So each participant in a Mojaloop system talks to the hub. It doesn't have any direct connection with the other participants. But what that means is that it interacts with the hub, I should say, in a standard way. So any institution interacts with the Mojaloop hub in exactly the same way. You can't tell from the way in which you get messages from an institution, whether it's an international bank or a large mobile money system or an MFI or a tiny village and savings loan association. They will all behave in exactly the same way. The API, which is one of the cornerstones of the Mojaloop system, enforces best practice for inclusive for inclusive instant payment systems. So we've figured out how we think payments are best managed, and we ask everybody to work in that way. So we enshrine best practice. We also enable participants to interact with confidence without needing to know who they're talking to. They can just need to behave in the right way, and they can be confident that other people will behave in the right way back to them. It's do as you would be done by in practice. And finally, it allows small, non-traditional financial institutions to get clear and unambiguous statements about how we need them to behave. They need to comply with the API. There's a clear statement of what the API contains, what they need to have, what they need to include, what they can't include. But it means that they don't have any doubt, or shouldn't have any doubt, about what they need to do to comply. But we also provide adapters which people can use to shield the complexities of the API interactions from what are sometimes the simplicity of their internal systems. So the adapter will look like their internal system on one side and look like a fully functioning Mojaloop system on the other side. And these are publicly available. People can download them. We have adapters for numerous kinds of standard core banking systems, Marfos, Temenos, those sorts of things. So people can configure them quite simply to be good citizens in a Mojaloop world. Second, I want to talk about other types of participants. Now, we want to extend the reach of the Mojaloop system beyond financial institutions themselves. Now, this is not to say that financial institutions aren't providing a 100% fantastic service to all of their customers, and indeed to all of their non-customers today. But nevertheless, we think that there will be creative innovations by people who understand the local market, which will drive up usage, which will drive up transactions, because people will be providing services that other people want to use, services which involve making or initiating payments. So examples of that, you can see merchant support applications, bulk payment managers, bill payment aggregators, invoicing agencies, and online marketplaces. All of these are things that innovative fintechs in local markets can easily set up, and we want to provide them with a simple way in which they can interact with the payment system. Now, one way in which we could do that is to rely on the financial institutions themselves, the banks, the mobile money companies, providing external APIs to allow people to connect with their systems and to initiate payments through those. The drawback of that is that not all of them will necessarily have the same API. It's certainly the case that open banking initiatives, certainly in developing economies, are often an aspiration, and that when you look at the actual content of the interfaces, they're very different from each other. And that means that a fintech who wants to, so let's imagine a payroll bureau, for instance, which needs to be able to interact with any financial institution where the payroll owner has their account, might have to do several different forms of API interface in order to be able to provide that service at any of the financial institutions where they might want to. So we have a third-party payment interface, and that provides a standard way for what we're calling third-party payment initiators, who are people like the Findex, to request and confirm a payment contract with a financial institution. That is, to make a request to a bank that the bank should give them, well, sorry, I'd say bank, I should say financial institution. Make a request to a financial institution that the financial institution should allow them to debit a particular account. Now, obviously, the financial institution will need to satisfy itself that it really is the customer asking that and not some bad actor saying, oh, excuse me, I'd like permission to debit Mike's account, please. So they will need to have some form of out-of-band confirmation that enables them to be confident that the request really did come from me and not from my bad acting cousin. So we allow that to happen. We provide support for various types of validation of that kind. And what we will then allow a third-party payment initiator to do is to initiate a payment from a customer's account according to whatever permissions the customer has said they may have. It provides confirmation also to the financial institution in an agreed form that the customer has assented to that particular payment. So that means that, for instance, smartphone users can use fingerprint recognition and the consequent signature can be passed back to the financial institution so that the financial institution can be happy, can be confident that I really did say, yes, you can go ahead and make this payment. And it also means that the third-party payment initiator can provide a payment service without any need to take a financial stake in the system. Now, I've lost count of the number of fintechs who've come to me and said, so what we want is a kind of escrow agreement where we put funds into an account which is kept in escrow so that it can't be used by anyone, and that's how we're going to do this. We want to say, no, you don't have to have any financial stake in the system at all. The funds will be transferred directly from the account that you have an agreement about to wherever they are supposed to go. You won't have any financial stake in the system at all. It also provides a standard way for a financial institution to give third parties controlled access to their customers' accounts. It means that if they want to, they can offload user experience to specialists. Now, I don't know what most of you feel about some banks, but they don't often, oh, sorry, I won't rephrase that. Oh, yeah, that was a bit unfair. Some banks don't provide the best possible user experience. And if you're used to using something like Google Pay, for instance, or Apple Pay, you might think that there are better ways to give a user experience. Now, for financial institutions who do not want to have the time, effort, and trouble of providing that user experience, this allows a way for a fintech to come in and say, it's okay, we will manage that for you, and we will just allow the customer to debit their account. It also reduces for the bank the cost of onboarding new fintechs because they're all using a standard interface. Once the bank supports that interface, then they can go out and get any number of fintechs to attach using the same interface. There is no, well, I would say no. The additional cost of new fintechs is low. And finally, it provides a way for the instant payment system itself to regulate those participants. Because those participants are participants in the system, though not of the same kind as the financial institutions, they can be regulated in ways which are effective and which meet the requirements of the jurisdiction where the scheme is implemented. Okay, so now I'm going to move on to the question of paying beneficiaries and not accounts. Now, account numbers are a kind of Masonic handshake. They're a way for institutions to say to each other, we belong to the same club, don't we? We're both banks. I can tell because you've got an account number, I've got an account number. We don't want to do that. We have, as I say, to take our customers where we find them. And we don't want to have to know how these institutions identify the customers. All we want to know is to be able to convert something that a sender knows about the beneficiary. It might be a phone number, it might be a nickname, it might be an email address, whatever, into a commitment from the beneficiary's financial institution that they will credit the right customer with that payment if the payment is routed to them. Now, it's a subtle distinction, but I think one that's of great importance to us. And we've certainly had conversations with Arunjay in the past about what the best way of managing this sort of thing is, because we really don't want to know anything about how the financial institution manages crediting the correct customer. And in particular, we want to leave KYC information with the financial institution. Again, we don't at present want to go into the business of maintaining central KYC information. So what happens in the Mojaloop system, if you ask, the question you ask in the Mojaloop system is, which financial institution answers for this particular identifier, this mobile number, this national ID number, that kind of thing. You get an answer back from the institution that says, I do, here is their name, and here, if appropriate, is their KYC information. So that is not stored in the Mojaloop system at all. It's just passed back to the requester, so that the requester, for instance, can go back to their customer and say, did you mean to pay Adrian Hope Bailey? Which you say, no, 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 definitely not. Ah, yes. Yes, the cup dashed from his lips, unfortunately. So, as I say, we want to leave KYC with the financial institution. So, we support multiple identifier types. We allow individual schemes to decide how to assign identifiers to FIs, to financial institutions, and how to manage the problems of uniqueness. Now, uniqueness is a looming problem for us. In particular, because we make no bones about it. Mojaloop comes from a mobile money system world. And a mobile money system world identifies accounts, broadly speaking, by phone numbers, MSDNs we call them. Now, where mobile money systems are operated by the mobile network operators, by the Vodafones, by the threes of this world, there is no problem because there's a direct identification between the mobile number and the mobile money system. However, there are lots of mobile money systems which are not operated by mobile network operators. They're operated by third parties. They also use phone numbers. But a given customer can belong to more than one of them, sometimes two or three. Worse than that, a family may be sharing a handset, and the one partner may be having a mobile account with a particular mobile money system. The other partner has an account with a different mobile money system. Both of those are identified by the same mobile number, even though they refer to two different people. So this is a problem we need at the moment to understand, to allow individual schemes to decide how they want to manage that. But one thing that's important to emphasize is that we don't, broadly speaking, have any interest in direct interactions with customers. We've talked a number of times about whether we should, but at present we've always said no, we're going to go through the financial institutions and not direct to the customers. So, we also provide APIs to allow participants to register their claim on a particular identifier. Again, it's up to the individual scheme to say, will I allow more than one person to claim the same identifier, like the mobile phone number in the example I was just talking about. We allow them to decide that. But essentially, there's an ideological divide in this world. One side wants to work with account numbers. or PANs or whatever, different kinds of direct representation of the account itself. What needs to happen there is that both the account holding financial institution and the requester need to agree on that value, but the beneficiary doesn't have to say anything about it. The identifier is an identifier which is assigned by the institution. The customer doesn't have to make any action in order to get that registered. But there are problems. For instance, there are jurisdictions where branch identification is either patchy or non-existent. A lot of people will talk about IBANs, international bank account numbers, but there are numerous jurisdictions in the world that don't use IBANs, and therefore for them these things are completely useless. So it's not an easy question of itself to resolve. It's also the case, for instance, that if you don't have proper branch identification, lots of banks are using the same core banking engines, and those core banking engines use parts of the account number to designate things about, for instance, what kind of account it is. So therefore, the chances of overlap between banks in account numbers is very high. And of course, the same bank account number in different banks will refer to completely different people. So it's a problem. The other side, our side, wants to work with identifiers. So that's just something which, it's a trigger which an account holding institution can use to decide which account or which person, which customer is being referenced. It doesn't have to expose the actual account to anybody else. It doesn't have to say anything about the assignment process itself. But the downside is that the customer does have to register their identifier with the account holding system. It has to, in the same way as you do when you sign up to PayPal or something like that. You will have to give the identifiers that you want to use to identify yourself. Okay, so that's the question of identifiers. Now I'm going to talk a little bit. Oh, I see it's counting down to 0. I told you there was going to be a lot of slides. Sorry, I should be paying more attention. Okay, let me gallop through this one. So according to the World Bank, 36 countries in the world receive more than 10% of their GDP by personal remittances. That's in 2020. In 4 of those countries, the average cost of remittances was over 9%. Remittances is one of the top 5 sources of finance for development, and Sustainable Development Goals say we should reduce the average cost to 3% and eliminate all remittance channels with an average transfer cost of 5% or more. So we do that via cross-network providers. They are basically simple. It's an adapter pattern. On one side it talks Mojaloop, on the other side it talks the language of the external scheme. Can things be that simple? Well, a cross-network provider has to belong to a settling participant in the scheme. There has to be some way for those funds to be transferred to the recipient institution. External systems often don't structure payments in the same way we do. Particularly, they don't have the agreement of terms phase, which, as I said, is quite uncommon among instant payment schemes. Oh, currency conversion. There are specific issues. I'm not going to go into those because they are quite complicated. But as we've started proofs of concept of external connection via cross-network providers, we've come to talk about these. If anyone wants to discuss them, I'll be very happy to talk about them afterwards. Specific initiatives, Mojaloop is a member of the ISO 20022 standards community, and we are in process of creating an ISO 20022 version of Mojaloop, i.e. something that will do the things that Mojaloop wants to do, but will be recognized as a standard by the ISO 20022 body. We are building a Rafiki cross-network provider, which will allow institutions which support the Interledger protocol to route payments to and indeed from Mojaloop schemes. And we're also building a cross-network provider to allow institutions which support the Visa Direct API, which is a proprietary Visa cross-connection scheme between identifiers, to allow them to route payments to Mojaloop schemes. However, the problem is not a technical problem. It's settlement. and the process of currency conversion. And at bottom, it's a problem of correspondent banking. Now, I was kind of hoping that Arunjay would talk about correspondent banking, but he didn't. And I'm not going to talk about it either, because you've been a good audience, and this will just depress you. So I'm going to tell you a joke instead. And my joke is, how many psychiatrists does it take to change a light bulb? The answer is only one, but the light bulb has to want to change. And these systems are like that. You can't implement these things technically unless the society and the regulatory environment wants to change. These systems, if they're implemented properly, will result in a new world, a world in which things will be different for everybody, different for banks, different for mobile money companies, different for people. And unless there is the political will to change institutions and to change regulations to support those things, they either won't happen or they won't happen successfully. So that is your reward for not hearing about correspondent banking. Thanks very much.